Hello, fellow economists and finance enthusiasts. Welcome back to our channel, where we delve into the intricate world of economics. Today, we tackle a critical question. Are the regional bank crises in America finally behind us? Join us as we examine the current state of these banks, evaluate the effectiveness of regulatory measures, and explore the potential impact on the broader economy. If you're as passionate about economics as we are, don't forget to hit that subscribe button and ring the notification bell to stay updated with all our insightful content. Get ready for an insightful journey into the realm of finance as we unravel the truth behind the regional bank crises in America. Let's get started. On May 1st, 2023, U.S. regulators seized First Republic Bank, FRB, and sold its deposits and assets to J.P. Morgan Chase. This aimed to stabilize the banking sector. Despite a $30 billion bailout, FRB failed. Established in 1985 in San Francisco, FRB was the 14th largest U.S. bank with $229 billion in assets and $104 billion in deposits as of April 13, 2023. It catered to wealthy clients, offering wealth management and brokerage services. FRB had upscale branches with amenities like green umbrellas and cookies for customers. Since March, the regional banking sector faced troubles with the rapid collapse of Silicon Valley Bank, SVB, and Signature Bank. These failures, along with FRB, were among the largest in U.S. history, exceeding the 2008 crisis. Factors behind the crisis included rising interest rates, uninsured deposits, regulatory rollbacks, and weak supervision by the U.S. Federal Reserve. Before diving into the full video, make sure to subscribe to my channel now to stay updated on all the latest videos and engaging content about the latest trends and predictions in economics. Now let's enjoy the video, An Unfolding Crisis. The crisis began on March 8th when Silvergate Capital Corporation, a cryptocurrency-focused bank, announced its voluntary liquidation after suffering losses from the collapse of FTX, a cryptocurrency exchange. Just 2 days later, U.S. regulators shut down SVB, a prominent lender to technology startups and venture capital firms in the San Francisco Bay Area. On March 12th, New York regulators also closed down Signature Bank, which primarily served cryptocurrency customers, in an attempt to prevent a growing banking crisis triggered by SVB's failure. Subsequently, First Republic Bank became the center of turmoil as anxious customers and investors worried about its potential collapse. The failed banks shared several characteristics: rapid growth fueled by short-term funding, heavy investment in long-term treasury bonds and mortgage-backed securities that incurred substantial unrealized losses due to rising interest rates in 2022 to 23, and a significant concentration of uninsured deposits and short-term liabilities that could be withdrawn at any moment. This mismatch between their assets and liabilities made these institutions vulnerable to runs by uninsured depositors. When uninsured depositors began withdrawing their funds in large numbers, it led to the downfall of these banks. In today's world, with online and mobile banking apps, withdrawing and transferring money from banks can be done quickly. On March 9th, customers withdrew a staggering $42 billion in a single day from Silicon Valley Bank, which subsequently failed the following day. This bank run, fueled by social media, occurred at an unprecedented pace. Patrick McHenry, the chair of the House Financial Services Committee, referred to SVB as the first Twitter-fueled bank run. Given that banking relies heavily on confidence, U.S. financial regulators were concerned that widespread bank runs and failures could pose significant systemic risks. To address this, they announced various measures, including deposit guarantees for all failed banks, emergency liquidity provision, and prompt resolution of troubled banks. The worst is not yet over. Despite regulators' reassurances that the banking system is stable after resolving the FRB issue, investor confidence in regional banks remains low. On May 4th, shares of PacWest Bancorp and Western Alliance plummeted by 51% and 39% respectively. As the Federal Reserve continues with rate hikes, regional banks face intense pressure from depositors and investors. These banks lack sufficient equity to absorb significant losses on their securities, leading to reduced deposits and higher funding costs that impact their profitability. A major concern is the potential credit crunch resulting from tightened lending standards by regional and other lenders. This will limit credit availability, particularly affecting small businesses and low-income households that rely on these banks for loans. Regional banks, despite lacking brand recognition, are vital in providing credit to small businesses and the commercial real estate sector. With rising interest rates and the ongoing impact of the pandemic, these sectors are already struggling. The instability caused by higher interest rates will likely push the U.S. economy into recession sooner than expected. Even in the best-case scenario of restored confidence and no further bank runs, the effects on the real economy and financial stability will be long-lasting. Misplaced blame. Regional bank failures are often attributed to poor management decisions, unchecked growth, and reliance on uninsured deposits. However, solely blaming individual banks and their management would be inaccurate. The interconnected nature of the financial world means that banks operate within a larger system, influenced by monetary policies and regulations. The U.S. Federal Reserve bears a significant portion of the blame for the crisis. Its fluctuating policies and inadequate oversight of failed banks contributed to the problem. The failures of regional banks are not isolated incidents and pose systemic risks. Ongoing banking turbulence suggests that runs on regional banks may not be fully resolved. Many U.S. banks also face substantial unrealized losses due to rising interest rates, increasing their vulnerability to bank runs and destabilizing the entire banking system. Academic research indicates unrealized losses of $1.70 to $2 trillion on U.S. bank balance sheets, almost matching the total equity capital of $2.2 trillion. Uninsured deposits, totaling approximately $9 trillion, pose a significant systemic risk. Even a partial bank run by uninsured depositors could force banks to sell securities at significant losses, potentially leading to bankruptcy. Around 190 U.S. banks are at risk of collapse if only half of uninsured depositors withdraw their funds. Even small-scale fire sales triggered by uninsured deposit withdrawals would put more banks at risk, according to a recent study. Fed's misjudgments. The U.S. banking turmoil can be largely attributed to the Federal Reserve's misguided focus on controlling inflation, resulting in rapid and excessive interest rate hikes over the past year. Regional banks face multiple risks due to the Fed's monetary tightening: unrealized losses on long-term securities, deposit outflows to larger banks and money market funds, and reduced profits from higher funding costs. Since March 2022, the Fed has raised interest rates 10 times, the most aggressive rate increase regime since the 1980s. These hikes were accompanied by quantitative tightening, reducing the size of the Fed's balance sheet. The current banking turmoil primarily stems from the Fed's flawed policy decisions. The Fed maintained an overly loose monetary policy for too long, even during the pandemic. Regional banks invested heavily in lower-risk long-term securities, but rising interest rates caused losses as bond prices fell. Higher interest rates led to deposit withdrawals, forcing regional banks to sell bonds at a loss to cover the outflows. Silicon Valley Bank and Signature Bank faced significant losses and panicked depositors due to their high proportion of uninsured deposits. The Fed should have been more attentive to the impact of rate hikes on financial stability. There should be no trade-off between price stability and financial stability, but the Fed prioritized the former over the latter. Regulatory rollbacks and lax oversight. Rollbacks and regulations by the U.S. Congress and a lax supervision by the Federal Reserve worsened the crisis in regional banking. The Trump administration weakened the Dodd-Frank Act, intended to ensure financial stability after the 2008 crisis. In 2018, the U.S. Congress amended the act, reducing regulatory requirements for banks. This exemption included Silicon Valley Bank and Signature Bank. These amendments were meant to relieve regulatory burdens on small and medium-sized banks, but 25 large banks, including Credit Suisse, also benefited. If not for these changes, the recent bank failures could have been prevented or addressed more effectively. Enhanced regulations like living wills and stress tests could have identified and addressed risks associated with interest rate hikes and reliance on uninsured deposits. Lax enforcement of existing rules by Randall K. Quarles, vice chair for supervision at the Fed, was another contributing factor. Reports from the Federal Reserve, FDIC, and Government Accountability Office acknowledge staffing shortages and delays in taking action. These regulatory rollbacks and lax oversight played a role in the ongoing crisis in the regional banking sector. Persistent vulnerabilities. Despite the Fed's efforts to address the crisis with liquidity injections and deposit guarantees, underlying vulnerabilities in the regional banking sector remain. These include unrealized losses on assets, rising funding costs, and a shift of deposits from smaller to larger banks. If the Fed continues to raise interest rates and pursue quantitative tightening, small and regional banks may face further challenges. The Biden administration has proposed improvements to bank regulation and oversight, but political obstacles and a divided Congress limit the likelihood of significant reforms or raising the FDIC's deposit insurance limit. Digital banking and social media amplify rumors, making it easier for customers to withdraw funds with a few clicks or swipes, leading to unpredictable digital bank runs that are difficult to manage. The regional banking crisis in the United States persists, with uncertainties surrounding future developments. Overall, the regional banking crisis in the United States continues to face persistent vulnerabilities, with uncertainties regarding future developments. Thank you all for joining us today on our deep dive into the regional bank crises in America. We hope you found our analysis and insights valuable in understanding the current state of these banks and their implications for the economy. If you enjoyed this video, be sure to give it a thumbs up and share it with your fellow economics enthusiasts. And remember, if you haven't already, don't forget to subscribe to our channel for more thought-provoking discussions on various economic topics. Until next time, keep exploring and expanding your knowledge of the fascinating world